Let's get to Eric Robertsen. He is Global Head of Research and Chief Strategist at Standard Chartered Bank, joining me now from Dubai. A very good morning to you, your side, and thanks for joining us today, Eric. Now, of course, the market is focused on the midterm elections. It's also looking for a Republican sweep. Which stocks, which sectors do you expect to benefit from this?
Well, one of the things I think we need to focus on, Emily, is that the Republicans have a very different approach to investment in natural resources. And, obviously with some of the issues around energy security, energy supply chains, I think a Republican sweep in the midterms, which lays the foundation for perhaps, Republican presidency in 2024, may start to raise hopes that you would see renewed investment in energy and shale in the United States. So that's something we'd be very focused on.
Now, these midterm elections are historically a boon for equities. Markets are typically the strongest when we have a 4-year term for a U.S. presidency. It's at the midterms, the quarter during Q4, Q1, and Q2, where we do see things really take off. Are you expecting something similar this time around? Because what we haven't seen previously is we've got huge inflation and rising interest rates at an unprecedented rate.
It's a great question, Emily. The way we would think about it is you have a bit of a confluence of events at the moment or potentially in the very near future. One is obviously the midterm elections and the historical patterns around equities that you mentioned. In addition to that, there's quite a bit of speculation about when the Fed may or may not start to reduce the size of its interest rate hikes. Our expectation is a downshift to 50 basis points in December. And the final factor is obviously the key question for Asia, which is when does China start to ease back on some of the zero COVID restrictions? So you have 3 potentially very significant factors, which if they all roll the right way, could be very supportive of risky assets.
Now, I'm going to pick apart the 2 points that you just raised there. First, the Fed pivot, and then to the Chinese and the zero COVID policy. Now, the stock market has been battered by this aggressive Fed tightening. When do you expect this pivot to take place, and where do you see the terminal level?
Sure. Look, as I said, our expectation for December is 50. We expect another 25 basis point hike in early Q1 of next year. And that would be our expectation for the full Fed hiking cycle. So that's a little bit below market expectations. Currently, the market sees a terminal Fed funds rate of just above 5%. There's certainly a risk of that scenario playing out. But I think by Q1, we'll be seeing enough of a deceleration in both growth and inflation that the Fed can really start to step away from the rate hiking platform. And as you highlight, and a few other speakers have mentioned as well, this has been a global tightening cycle, and we've seen significant policy hikes in both developed and emerging markets. So I think by Q1, there will be a very good stage set for a potential pivot from central banks.
Now, as we look to China and its zero COVID policy, officials there have said that they're sticking to these plans, that there's no intention to let up. But the market seems to think otherwise, because at least here in Hong Kong, we've had a couple days of rally where the market has put on something like 13% just in this month alone. Does the market know something that we clearly don't?
No, I don't think so. I mean, I think the way to think about it is that the rolling back of zero COVID restrictions is not going to be a binary event. It's going to be very slow. It's going to be very gradual. It will be very incremental. It'll be a multi-step process. I think what the market has sort of cottoned on to is that once that process starts, there will obviously be partial reversals along the way, but the path of travel is very clear. And so I think the market will tend to look to the future and say there is now light at the end of the tunnel where there has not been before. The final point to make is that positioning and sentiment in global equity markets, but specifically in Hong Kong and China, has been extremely negative. So even if we were to see a partial reversal of those short positions or those underweight positions, that can give quite a bit of support to equity prices.
Now, we've got less than 1 minute to go, but have to ask this now. So long as China sticks to its COVID zero, this would be deflationary, right? Would this be good for the global market?
There's two ways to think about that, and I think it's a really important point for 2023. The supply chain challenges that we have seen over the last year have been partially a function of COVID restrictions around the world. And so you could argue that a reopening of China and an improving supply chain story would ultimately be disinflationary for next year. And I think that would be an important point that might support a potential pivot from other central banks as well. So a key factor to focus on.
Eric, we're going to have to leave it there. Thank you so much. Eric Robertsen from Standard Chartered Bank.